Welcome, everyone. The Paul Streeten Distinguished Lecture in Global Development Policy celebrates the example and legacy of former Boston University Professor Paul Streeten, an eminent economist and interdisciplinary scholar. This lecture is sponsored by the Boston University Global Development Policy Center, the Institute for Economic Development, and the Department of Economics. I am Dilip Mukherjee, representing the Institute and the Economics Department. I will start the proceedings by introducing the lecture and the speaker. After the lecture, there will be a Q&A session moderated by Kevin Gallagher, Director of the GDP Center. The Streeten Lecture has a number of interrelated goals: to honor the impact and legacy of Paul Streeten, to shine light on scholars working in the Streeten tradition who pursue rigorous scientific research while connecting with other disciplines and the policy community to advance global development. The lectureship also hopes to inspire younger scholars to pursue interdisciplinary research on pressing development problems and thereafter engage actively with the policy community. This year's Streeten Lecture will be delivered by Ishwar Prasad, the Tolani Senior Professor of Trade Policy at Cornell University. Ishwar received his BA from the University of Madras, nowadays known as Chennai, in 1985, MA from Brown in 1986, and a PhD in economics from the University of Chicago in 1992. He has published more than 40 articles in macroeconomics, labor, international trade, and finance in top research journals. He is the author of 3 books: How the US Dollar Tightened Its Grip on Global Finance in 2014, The Rise of the Renminbi in 2016, and most recently, The Future of Money, How the Digital Revolution is Transforming Currencies in Finance. And this last book was on the best economics books of 2021 list of The Economist, the Financial Times, and Foreign Affairs. Very much in the Streeten tradition, Professor Prasad combines a prolific research and writing career with extensive policy engagement and media outreach. He was chief of the Financial Studies Division of the International Monetary Fund's Research Department. Before that was head of IMF China Division. In the been in the IMF for 17 years. I had no idea that it was as long as that. He has testified before the Senate Finance Committee, the House of Representatives Committee on Financial Services, and the US-China Economic and Security Review Commission. His research on China has been cited in the US Congressional Record. He was a member of a high-powered committee on financial sector reform appointed by the Indian government, and he continues to be involved in advising them in relation to G20 activities. He is the creator of the Brookings Financial Times World Index. Many of his papers and speeches have been cited extensively in prominent media outlets, as have his op-ed articles. He makes frequent appearances on media and television channels. So we are very, very happy that he has chosen to make an appearance here today at Boston University. Professor Prasad.
For all the fears that some of you may have about it, globalization is not yet dead. That might be good news for some of you, not so good news for others. But before we think about how we arrive at that conclusion, it's worth thinking a little bit about what globalization was supposed to accomplish, how it actually played out in terms of experiences on the ground, and where it is likely to be headed. And as we go through this journey, we will touch upon a variety of interrelated topics, including where things are headed in terms of global governance, how one might think about the new international economic and financial order, and then how new innovations fit into this, especially innovations in the forms and creation of money. I speak, of course, of cryptocurrencies and the revolution they have created. And while this might seem a distinct topic it's going to be very much related to how the international economic order is likely to evolve and what implications it might have both within countries and across countries. Many of these topics that I will speak about are indeed very appropriate for a Streeten lecture, because Professor Paul Streeten was well ahead of his time in thinking about some of these issues. Back in 1981, in fact, he had an important paper on the new international economic order, where he spoke, for instance, about how the countries of the OECD, the advanced economies of the time, needed to think about recycling their surplus capital into the labor surplus economies of the developing world. In 2001, he had a book about globalization. He talked about the potentials and also the opportunities, but also many of the threats that globalization posed. So it is quite a privilege indeed to be delivering the Paul Streeten lecture. And of course, Professor Streeten has left his legacy not only in terms of his writings, but in terms of the enormous strengths that Boston University has to this day in terms of research on many of these issues. We, of course, have the center that Professor Gallagher is affiliated with, but the economics department, in the guise of Professor Mukherjee and very many other distinguished faculty, has brought together some really important intellectual forces to think about these issues. So all of you are at a very good place to be thinking about these big, broad questions. And in fact, in discussions with students today, this is the sense I got, that many of you, while of course you're doing your academic research that is sometimes much more narrowly focused, are in fact inspired by these big, broad questions. And of course, you're in a very good place to be thinking about how your academic research connects with policy. So let's start with the promise of globalization. In fact, even when we bring up the very term globalization, in his 2001 book that I referred to, Professor Streeten offers us nearly 35 different definitions of globalization. So it's well worth a read, if for nothing else, just to look at those definitions. I'm going to think about it as basically broader trade and financial integration undertaken by countries as they integrate with each other. Now, one can think about the flows of goods and services, the flows of money, the flows of people, the flows of ideas and technology as all being very much related. But as we think about this from an analytical perspective, it's trade and finance that were essentially the key channels of globalization, and indeed were the conduits through which some of these other types of flows might well have parlayed themselves. Now, one can think about what globalization was supposed to accomplish. It was, in a sense, supposed to tie the world together and bring benefits to the world at large. So going back to Professor Streeten's ideas, the notion might be that if you have a lot of capital in the advanced economies of the world and a lot of labor and less capital in the developing economies of the world, you could benefit everybody in the world by moving some capital and moving it to more productive parts of the world. So if you have a lot more labor and less capital in the developing world, you could make international investors in the advanced economies much happier because they could get higher returns on their capital by moving it to the developing countries. And developing countries, if they were short on capital, could benefit from having more financing that they could use to generate more investment and more growth. This was the idea. And trade was another very important conduit through which you could think about countries benefiting by specializing in different parts of the supply chain or in specific products and services that they had a comparative advantage at. So the economists like beautiful theories, and this was a very elegant set of theories that told us about how trade and financial globalization should benefit practically everybody in the world. It was supposed to enmesh countries in this web that was supposed to be mutually beneficial. It did not quite play out that way. It turns out that there were a number of anomalies in terms of how trade and finance played out on the international stage. If you think about the flow of capital, logically, it should go from the richer countries to to the poorer countries. But we had a period during the 2000s when, in fact, capital very oddly flowed uphill. It flowed from poorer countries to richer countries. There were large economies like the United States, the United Kingdom, Spain, that were running current account deficits, which essentially meant that they were living beyond their means. So they had to finance their excess spending relative to their output through foreign finance. And where did this financing come from? It came from many low to middle income countries. Countries like China and a variety of other emerging market economies ran current account surpluses, which means that they were essentially exporting capital. Now, this was a very topsy-turvy world. But interestingly, in some of the work that I did with co-authors of mine, including Kenneth Rogoff, Raghuram Rajan, Arvind Subramaniam, and so on, we found something paradoxical. You would think that countries that are relatively short on domestic savings and that are exporting what little resources that they have should grow slower. In fact, that was not the case. Now, China, of course, is a prime example of a country that has been exporting capital for a long time. It has been running current account surpluses, and yet it's registered very good growth rates. But it turns out it's not just China. A lot of emerging market countries do seem to have done very well when they were able to use their domestic savings more effectively and not rely on foreign savings. And in fact, there is also some evidence that many of the countries that undertook integration into global financial markets, which of course are the emerging market economies, suffered in terms of another benefit that they were supposed to get from financial globalization. One benefit, as I've been alluding to, is growth. The other is risk sharing. And the idea here is very simple. If you want to think about countries that are subject to a variety of shocks and disturbances, you want to be able to insure away those country-specific disturbances. If you think about home insurance, for instance, or health insurance, all of us in this room are relatively healthy, which I guess is why we are able to show up here. But if you think about health insurance, what the health insurer is doing is spreading risks across the population. So we can pay premiums that then give us access to healthcare when we really need it. Now, when we transpose this to the international context, the idea is that you cannot insure against country-specific risk because everybody in a country is exposed to the same amount of risk. But if you can use international financial markets to insure against country-specific risk, then all of us could be better off in terms of a risk-sharing sense. And this is where international capital flows were supposed to have an added benefit. It turned out that even this benefit did not work out very well, in fact. So countries that did integrate into global finance did not attain the risk-sharing benefits. It turns out that there is one group that did get the right sort of benefits from financial globalization. I have mentioned two of these benefits. It is supposed to get better risk-sharing, and you're supposed to get better growth if you can get foreign finance. It turns out that the countries that did benefit were, in fact, the advanced economies. So countries like the US, the UK, and many other advanced economies did, in fact, benefit from foreign capital inflows, and they also got more risk-sharing benefits, while the emerging market countries that were supposed to get these benefits didn't really get it. So there is a paradox that is forming here. In fact, a series of paradoxes. First, it's not the emerging market economies that are generating the right sort of benefits that you would expect. Second, the countries that are less reliant on foreign finance do seem to have better growth benefits. The third paradox, which is the really interesting one, is that despite this, because we academics take a little while to catch up with the reality, but surely people on the ground were feeling these effects, but countries have continued to open up their capital accounts. They have continued to integrate into global finance and trade. What is going on? Even if you think about countries like China and India, which still maintain restrictions on capital flows across their national borders, capital controls, they are also continuing to open up their capital accounts. And of course, many countries have integrated into global trade. What is going on here? I think there is a different set of benefits that countries have perceived. In some of my work, I've referred to these as collateral benefits. It's not the money that really matters, but the indirect benefits that come from opening up. Let me give you a few examples. And Professor Gallagher has written about some of these issues in his work on international finance. As you think about China opening up, for instance, what China needed was not so much foreign money, because China has a very high level of domestic savings, but it needed technological expertise. It needed other forms of expertise. It needed better corporate governance practices, better auditing and accounting practices. It needed deeper and more liquid financial markets. And it saw an opportunity in bringing in foreign investors who could bring in some of this expertise. In addition, they could potentially also bring in more money into specific parts of the financial system that could make the financial system work better. And China has used this playbook for a long time. In fact, there was a period in the early 2000s when China was trying to get its state-owned banks to reform themselves. Now, in China, the state-owned banks don't have much of an incentive to reform themselves, because much of their lending has been to state-owned enterprises. And that's pretty safe lending, because after all, the government stands behind it. But what the government saw was an opportunity to give these banks the opportunity to go out and list on the stock exchanges. In other words, they could raise more capital, raise more funding. And the bargain was that these banks would go out and improve their corporate governance and risk management. It wasn't quite working. So what did the Chinese government do? It said, let's bring in foreign banks, give them small ownership shares in Chinese banks. It was very limited ownership. No foreign bank could hold more than 10% of the equity share in any Chinese bank, and the total ownership of all foreign banks collectively could be no more than 25%. But 10% is enough to give a foreign bank a seat on the board, for instance, which could start improving corporate governance, which could improve risk management practices. And now the foreign banks might have an incentive to get these Chinese banks to do better. Now, all of this happened in 2005, 2006. By the time we came to 2008, the notion that you could have Western banks, say the JP Morgans, the Lehman Brothers of the world, come in to teach Chinese banks how to do risk management better might seem like a truly absurd notion. But at the time, the concept was a very good one. China has brought in foreign direct investment in order to acquire technology and other forms of expertise from the rest of the world. India has liberalized its equity markets as a way of improving the functioning of equity markets, because foreign investors bring discipline. So these collateral benefits play a very important role. Now, this is going to have a very important implication as we start thinking about where globalization is heading. Because some of this is past. Many countries like China and India, although they continue to open up their capital accounts, have reached a level of income, a level of economic development where the need for foreign technology and expertise is less. But China still wants to upgrade its technology, move up the value-added chain. It still needs foreign technology, which is why it continues to remain engaged with the rest of the world. There were other problems with globalization. We've seen this in the US as well, where the integration of China into the global trading system resulted in US manufacturing being dented quite severely. So we've had globalization essentially create much more inequality in the world within countries, but also across countries, where many countries did not benefit from this wave of globalization, and in fact may have gotten hurt to some extent. One of the very interesting features of financial globalization is that as we look at the 1970s, 80s, 1990s, we had some spectacular, from an economist's point of view, crashes in the emerging markets. Spectacular in the sense that when things crash and burn, we economists are sort of like ambulance chasers. We learn a lot from those very difficult periods. And those are very difficult periods that people in those countries more broadly have to go through. But they do serve as very important crucibles for our economic theories and teach us lessons that might be relevant in much broader contexts. Now, many of these crises that these emerging market and developing countries experienced was as a result of one particular type of financial flows that these countries received, which was foreign currency denominated external debt. Now, that combination of words sounds a little scary in itself. The thing about debt is that it does not involve very effective risk sharing, because the borrower commits to pay back loans unless he or she goes bankrupt or the country goes bankrupt, but to pay a specific amount in terms of a return, and typically also in a foreign currency. So all the odds are stacked against the domestic borrower. The foreign borrower, of course, gets a safe rate of return, typically in a foreign currency. So the currency risk is taken away as well. If you think about things like foreign direct investment, where a foreign investor goes invest and buys a company in a foreign country or sets up a new company, or portfolio equity investment, where a foreign investor buys stock or shares in a company in a foreign country, then the foreign investor, in the case of FDI and equity, bears some of the risk. The return risk, the value of those equities could fall. The currency risk, the value of that currency could fall. That is shared between the foreign investor and the domestic recipients of that money. So that is much better from the developing countries' perspective. Likewise, many of these collateral benefits that I spoke about, they come with FDI and portfolio equity. So in the 70s and 80s, about 80 to 85% of emerging markets' external liabilities, and their liabilities to the rest of the world, were in the form of debt. That has changed. That has changed very, very significantly now, with emerging market countries largely receiving their foreign financing in the form of foreign direct investment and portfolio equity. But this does not necessarily mean the risks are over. There are two types of risks still out there. Number one is a set of countries that the Center, for instance, studies, which is low-income countries which continue to rely on debt financing from private markets, from bilateral creditors, of which China is a very important one, from official creditors like the IMF and the World Bank. And while emerging market countries that are more developed are getting the right sorts of funding right now, even that is volatile. And it has created this very awkward situation in international finance right now, where the actions of many of the advanced economies, in particular one economy where we are all right now, the US, can have very significant effects on the macroeconomic policy making of even emerging market countries. So even if you're getting foreign direct investment and portfolio equity investment, it turns out that those can be very volatile, those can be very sensitive to what the Federal Reserve does and macroeconomic conditions in the US more broadly. And this raises another set of risks. So this is another issue that we will come back to: what role the US dollar is playing in the global financial system, and whether we might be at a turning point where things are beginning to change. So as you can see, I've laid out the potential benefits of globalization, how it actually worked out in practice, and in some ways it is working out, but it is creating even more complications along the way. But the background to all of this is that even though one might argue that there are lots of perils to becoming more financially integrated, the reality is that the world is proceeding towards becoming much more financially integrated. Now, this has had some important effects, not just in terms of finance, but also in terms of trade. We've seen global supply chains proliferating because while there's been movement in the context of finance, we've also seen transportation costs falling across countries. In addition, we've seen trade barriers in a number of countries fall away as many of the emerging market economies become more integrated into the global trading system. So we have much more lean and mean supply chains, which from the point of view of consumers are wonderful because they mean cheaper goods, especially when you're in the US, a country which has a currency that tends to be quite strong in normal times, and especially in perilous times of the world economy. That's a pretty good thing. Of course, it means a dislocation in terms of jobs in many parts of the world. But if you think in terms of aggregate welfare, there are certainly some benefits to be had still. Both trade and financial globalization are, I think, at a point where there are some very important changes coming. Now, what are these driving forces that are causing these changes? One of the things that producers have realized is that while lean, mean, and efficient supply chains are a blessing in terms of reducing costs, improving efficiency, there are costs. These costs come from a variety of sources of disruptions. These sources of disruptions can be related to geopolitical tensions, US-China tensions. You can think about various other geopolitical conflicts that have affected the supplies of oil and other commodities. Then there are tensions at a more basic level related to trade, such as the US-China trade tensions. We've seen climate-related disruptions having significant effects on these supply chains. Some years ago, when floods hit Thailand, which was a very important supplier of certain chips that go into cars and computers, the supply chains were really stymied for a pretty long period, a number of months, which can be devastating from the point of view of production. And then, of course, we had COVID-related disruptions. So all of this is leading to a subtle but very important change in the way we are going to approach globalization. I think the notion of sticking with efficiency is going to give way to putting a priority on resiliency of supply chains. Now, this has an important set of implications as we think about what can deliver more resiliency. One approach is diversification. So if you think about where you're getting your inputs from, your intermediate goods, your raw materials, what sort of markets you have, diversifying the sources of the different parts of the production chain, diversifying your markets is one solution, but it is expensive. Another approach is to think about some degree of concentration. You've no doubt heard the terms onshoring and friendshoring. So the notion of onshoring is parts of the production chain that have slipped out of the country, you bring them back to the country where things are more under your control, and at least some of these risks that I spoke about, especially the geopolitical risks, can certainly be curtailed. But in fact, we are seeing a lot more of this notion of friendshoring as well, because there are certain industries that are really not going to be competitive in certain countries anymore. But if you think about the North American continent, of course, once upon a time, we had NAFTA, and now thanks to Trump, we have USMCA. But the idea is that these three countries do provide the opportunity for integrated supply chains that are much less disruptive to geopolitical disruptions. And this is what we are beginning to see right now. Countries relying more on other countries that are geopolitically aligned with them. We are beginning to see what the IMF in a forthcoming study is going to call geo-economic fragmentation. The idea is that as you start looking at FDI flows, these are beginning to bunch up among countries that are much more geopolitically aligned. So if you think about the US, Canada, and Mexico, sure, the US and Mexico, the US and Canada have their differences, but it's not on the order of magnitude of the US-China differences. So if you can bring the production chains here, then you eliminate at least some sources of risk. Now, there is some analytical work showing that you may get additional resiliency, but it is going to come with some degree of welfare costs, because once we step away from efficiency, we are giving up something in terms of aggregate welfare. But producers around the world seem to be moving towards this. Now, this is not happening overnight. It's not really easy to find an alternative to China in the supply chain overnight. We've heard about India and Vietnam perhaps stepping into the breach. But it's not easy to rejigger supply chains overnight, especially at a time when financial conditions are pretty tight around the world. So this is beginning to take shape, but it's not quite happening yet. But I think this is going to be the wave of the future. So at some level, all seems good, right? We onshore, we friendshore, we're going to live in a much more safe world, at least in terms of production chains and so on. I'm not so sure. I think there are some risks ahead. One of the big risks, and we had some discussions of this in the earlier meetings that I had with students, climate change and the disruptions that it creates are a pretty serious risk. And if you think about concentrating production spatially, you're exposing yourself much more to that risk. Not only concentration within a country, but even a regional concentration can be much more susceptible to that kind of risk. I spoke about geopolitical risk being mitigated. There too, there is a risk. When you think about the US-China tensions, for instance, there used to be two sets of factors at play. One was the economic tensions between the two countries. But saner minds in both countries recognized, and saner minds includes reform-minded officials in China and free trade-oriented people in the US, used to believe that this was a mutually beneficial relationship, that if the US and China had close trade and financial linkages, both countries could benefit. The geopolitical aspect, however, has always been a zero-sum game. If China gains more influence in Asia, it has to come at the expense of the US. So you had on the one hand, a potential positive sum game, which acted as a check and balance on this zero-sum game. So US-China tensions at some level could be held at bay because there was a sense that it was important to maintain this mutually beneficial economic relationship. But now we are entering a world where even in terms of the economic relationship, it is coming to be seen as a zero-sum game. And again, this relationship between China and the US is most emblematic, but this is a broader tension that is emerging in the world economy. If you think about China or India investing in green technologies, trying to think about how they can promote their own industries, you have in China, the Made in China 2025 policy, which is supposed to promote indigenous innovation. And they also have what is called the dual circulation policy, improving the resiliency of the domestic demand system while still keeping the economy engaged with the rest of the world, basically increasing self-reliance. India has the Make in India policy. So you might think that these are industrial policy type actions by the emerging market economies going back to the old playbook. But look at what's happening in the US. We have here the Inflation Reduction Act, which had many elements of providing subsidies to industries that the US sees as the wave of the future and where it feels there are existential threats coming from emerging market countries like China. If you think about the CHIPS Act, there are many elements of that act that one could think about essentially as protectionist tendencies of the US. So practically the entire world is retreating now into a world of more focused industrial policies with more direct government intervention, where essentially there is an element of trade protectionism and potentially also financial protectionism entering into it. So I think we are moving into a world which is potentially much more fraught with risks, where the economic and geopolitical risks and tensions, rather than balancing each other, might end up feeding into and reinforcing each other. Another risk is related to a group of countries that is not yet that integrated into global trade and finance, and these are the low-income developing countries. Now, these are countries that are not receiving large amounts of capital, that are still not well integrated into global trade, and these are the countries that really need to attain many of these collateral benefits that I spoke about earlier in terms of financial market development, institutional development, and so on. And I fear that we may create even more balkanization of the world economy if, in fact, we have these silos being created by the countries that have already attained advanced economy status, or at least middle income status, as we start seeing this geo-economic fragmentation. So I think there are some very significant risks arising in different parts of the global economic system. And how exactly the international economic order plays out in all of this is a little hard to tell, but I think we are certainly going to see a lot more fragmentation. And my concern is that this is going to lead to potentially much more volatility rather than stability. Now, this all sounds like a lot of doom and gloom, so let's turn to something that is a little more exciting, which is the world of cryptocurrencies. Timing is everything in finance, economics, and so on. And the appearance of the original cryptocurrency was impeccable. The Bitcoin white paper, which sort of advertised its emergence to the world, appeared on an emailing site about 6 weeks after the Lehman moment, September 15, 2008, when it looked like the entire US financial system was going to go down and take the global financial system down with it. So this was a time when trust in institutions, especially central banks, governments, traditional banks, was at an all-time low. So the notion of a medium of exchange that would allow you to undertake transactions without using central bank money or a trusted third party, such as a credit card company or a commercial bank, was very appealing. And Bitcoin got traction, and it started gaining traction soon after that. So is the world of cryptocurrencies leading us to a better future? Now, it turns out that Bitcoin, for all of its technology, and it is really cool technology. If you think about it, if I needed to, conduct a transaction with Professor Gallagher without my knowing who he is, I trust him. But if I didn't even know him, if there was a digital Gallagher, a digital Prasad, how could we conduct transactions with each other without a trusted third party? There are all sorts of complications, because if you think about digital money, unless like a physical dollar bill, I could send it to multiple people. I could send it not only to him, but to Professor Mukherjee and maybe to 10 others of you in this room. How can you prevent double spending? How do you make sure that there is a mechanism in place for updating our balances so that when I give the money to Professor Gallagher, or better yet, Professor Gallagher gives the money to me, that both our balances get updated? It turns out that Bitcoin, or the creator of Bitcoin, whoever that was, ever since I wrote my book on the future of money, I've been at a number of crypto conferences, and I've sat at panels with 4 people so far and counting, who've all claimed to be the Satoshi Nakamoto who designed Bitcoin. I don't know who the true creator is. We don't know yet, but it's very ingenious technology. Essentially, it solves the problem by posting the transactions on multiple digital ledgers, the blockchain that is maintained on multiple computers around the world that are synchronized in real time. There is a little more to the technology, but I view it as a radical transparency, in a sense, getting around the need for institutionalized trust. Now, the technology is cool, but it doesn't work in one very important sense, which is that Bitcoin doesn't work well as a medium of exchange. If I go into a coffee shop and on one day, with a fraction of a Bitcoin that I have, I can buy a small cup of coffee. The next day I go in, I can buy, 2 large lattes with whipped cream on top and 2 croissants. That's not a great medium of exchange. It's too volatile in value. So it turns out that Bitcoin did set off a revolution in a couple of ways. The first is that it has led to the emergence of lots of new cryptocurrencies that make up for the failings of Bitcoin. There are some cryptocurrencies now that have stronger anonymity than Bitcoin. There are new cryptocurrencies called stable coins that essentially get their stable value because they are backed up by reserves of fiat currencies, which is sort of ironic because the whole point of Bitcoin was to get away from fiat currencies, and stable coins, fiat currency backed stable coins, get their stable value by being backed up by fiat currencies. It is a grand and delicious irony, but it is interesting that many of the elements of the crypto world that are working do still seem to rely on trust to some extent or the other. The cryptocurrency revolution, I think, the second aspect, which is really important, whatever happens with cryptocurrencies, because if you think about Bitcoin, in my view, it's become a pure speculative financial asset because there is no intrinsic value to Bitcoin. I've argued it doesn't work well as a medium of exchange. Bitcoin devotees, and I suspect there might be a few of them in this room, will tell you that the reason Bitcoin has value is that unlike US dollars, which can be printed at will in infinite quantities by the Federal Reserve, Bitcoin is scarce. It is hard-coded into the algorithm that there will be only 21 million Bitcoins, of which about 19 million have been created so far, and they're created on a very set schedule. Right now, about 6.25 Bitcoins every 10 minutes, or for every block of transactions. So surely something that is scarce must hold its value relative to something that can be produced in infinite quantities. To me, as an economist, this is a slightly dubious proposition that just because something is scarce, it should have value. but so be it. Lots of people seem to think it has value. And if I had been smart enough to buy Bitcoin when I was writing my book instead of working on my book, maybe I would have been a richer man for it. But I have the book, but no Bitcoin. There are other things that Bitcoin and other cryptocurrencies have shown us. What they have pointed to, I think, is really going to be transformative, is they have shown us the inefficiencies that exist, that pervade our financial systems right now. Even in the US, about 5% of households are unbanked or underbanked. They don't have access to basic products for managing credit, savings, insurance, and so on. In much of the developing world, this is an even bigger problem. If you think about international payments, and some of you may have tried, sending tuition payments or payments to families back home, it's extraordinarily cumbersome, expensive, slow, difficult to track in real time. There are many financial institutions that are benefiting, in a sense, from things being the way they are. I think what cryptocurrencies are moving us to is a world that will be better, not because it's a world of cryptocurrencies, but because they're highlighting how technology can be used to get around many of these inefficiencies. Take international payments. There is a cryptocurrency, Ripple, which has conducted proof of concept work to show that you can basically conduct international transactions, which are complicated, because you have to deal with multiple currencies, institutions operating in different regulatory jurisdictions, but you can basically settle those payments effectively instantaneously. And as you start thinking about it, with the technology we have, this should be possible. So we are moving to a world where I think financial institutions themselves are beginning to understand that this should happen. Now, while the world is moving towards digital payments of various sorts, either in the form of cryptocurrencies such as stable coins that use fiat currencies more efficiently, your basic payment systems like Venmo, Zelle, and so on, central banks are recognizing that there is one important change on the ground. Essentially, we're all going digital. In a small group earlier, I asked for a show of hands. So how many people still use cash? There was me and one other student, nobody else. The reality is that cash is disappearing. In a country like China, the use of cash has been supplanted by very easy to access low-cost digital payments provided by Alipay, WeChat Pay, and so on. In advanced economies such as Sweden, in emerging markets such as Brazil, digital payments are taking over. So central banks don't really need to issue currency. We think of this as their main job. This is not really their main job. Even if a central bank was not issuing physical currency, it could still conduct monetary policy in order to maintain low inflation, promote financial stability, and so on, because it can still affect the cost of funds in indirect ways. But central banks around the world are beginning to experiment with CBDCs, so central bank digital currencies. Why are they doing this? In some countries, the idea is to broaden financial inclusion. The Bahamas has issued the world's first nationwide CBDC, aptly called the Sand Dollar. And the Bahamian Central Bank views this as a way to give everybody, no matter what the income level or net worth, easy access to a low-cost digital payment system. In Sweden, the Riksbank wants to have a backstop to the private payments infrastructure. Why? In good times, the private sector can do perfectly well, but there might be crises of confidence, technological vulnerabilities. So you want to have a public payment system as a backstop so the economy doesn't grind to a halt. And then there is China, which, as usual, is sui generis. In China, as I mentioned, Alipay and WeChat Pay are blanketing the economy with low-cost digital payments, but it's become essentially a duopoly. There are limitations on other payment providers who can access this space because these two payment giants make it very difficult for other payment providers to enter, which could limit competition, which could limit innovation. And the Chinese government noticed that these two payment giants were hoovering up large amounts of data from their payment platforms, which until recently, they were not willing to share with the government. So the digital renminbi or digital yuan is seen as an alternative payment option that could create a little more competition in this payment space. So now there is a raft of countries, China, India, Brazil, Sweden, Japan, and a host of others that are undertaking CBDC experiments. So that is really coming. Now, is this going to affect things in the world? So now let me step back and in the context of the evolution of cryptocurrencies, talk about one last and fairly engaging theme, at least based on my line of research. Is this going to fundamentally alter the international monetary system? Now, here is the reality. The world outside the US loves cheap dollar funding, loves having easy access to the dollar as a means of payment, but despises the fact that the dollar is so dominant. And the dollar is dominant in every respect as a payment currency, as a funding currency for corporations raising debt, as a currency on the other side of FX swaps, which is a very large financial market, as a reserve currency. People don't like the dollar. It has a lot of negative implications for emerging market economies because a lot of their funding, their external funding by their corporations, in some cases, their government is in dollars. So when the US hikes interest rates, the dollar rises, the cost of that funding goes up, and those currencies depreciate against the dollar. So the cost of repaying those dollar-denominated instruments rises. It causes a lot of problems for the rest of the world. And there is a geopolitical overlay to this as well. We have seen that the US is able to effectively deploy financial sanctions as a geopolitical tool. When Russia invades Ukraine, when the US does not like Iran's policies or North Korea's policies. And these sanctions have a bite because a lot of international payments still need to touch the dollar-based payment system because it remains the most important invoicing and payment currency. So countries would like to get away from this. Do they have an option? There is change coming. But this change was actually already coming, and it was coming because of developments in emerging market economies. If you think about China, we've heard about China. I just mentioned to you, China introducing a digital yuan. Is this going to fundamentally alter the renminbi's role in international finance? Professor Gallagher might have a slightly more nuanced view about this. I think not. I think that most international payments are already digital, and easy availability of a digital yuan is not going to fundamentally alter this. If you think about a reserve currency, it needs to have the trust of international investors. So just because the yuan is available in digital form, it's not going to change the yuan's role in international finance. But there is another game changer. China's cross-border interbank payment system, aka CIPS. CIPS is very important because it is a payment system that can directly communicate with the payment systems of other countries. And it turns out it can also be used as a messaging system that can go around SWIFT. SWIFT, that you've heard a lot about in the context of financial sanctions, is just a messaging system. Actually, payments don't go through it. But because there are differences in technological protocols, languages across countries, SWIFT basically provides a uniform protocol in which messages about payments can be sent. And then there are other conduits for those payments to be actually transferred. So SWIFT is based in Brussels. It's non-partisan, but SWIFT could not survive if US banks pulled out of it, which the US could orchestrate. So SWIFT is under the thumb of the US, at least this is the impression of the world. But China's CIPS could directly communicate with the payment systems of India, of Russia, when those payment systems reach maturity. But it's not just that. You can now think about transactions more directly being conducted between Chinese renminbi and Indian rupees without having to go through an intermediating currency such as the US dollar, or for that matter, the euro. Likewise, renminbi to rubles transactions or renminbi to transactions with many other currencies could be undertaken without vehicle currencies. This change is coming. I think the prominence of the key currencies, the dollar, the euro, the pound sterling, the Japanese yen, and a few others as payment currencies is going to decline because their role as vehicle currencies is going to decline. And as emerging markets, financial markets become more developed, so you can do more hedging of those bilateral cross-currency pairs, this will pick up speed. Geopolitical forces will add to these imperatives because China, Russia, India, and even Europe doesn't want to be so much under the thumb of the US anymore. As a payment currency, therefore, I think the dollar's role might erode. Even that is not a sure thing. It turns out, as I mentioned earlier, that stable coins are playing a very important role in international payments. Guess what stable coins are getting the most traction in international finance? No prizes for guessing. It's dollar-backed stable coins rather than stable coins that are backed up by other currencies. So in fact, you could end up in a world where the dollar indirectly becomes an even more prominent payment currency, although that's not necessarily an argument I'm pushing, but it's not obvious that even the dollar's decline as a payment currency is a given. In fact, what I think is more likely is that we're going to have the other currencies, such as the euro, the pound sterling, and the Japanese yen, lose their shares, while the dollar perhaps has a small erosion in its share, but does not face significant erosion relative to the other currencies. What about as a reserve currency? Here again, geopolitics comes into play. Emerging market countries accumulate foreign exchange reserves so that they can have access to them when a rainy day comes. What is a rainy day for an emerging market? When capital is flowing out of the country, the currency is depreciating, so you need foreign currencies in order to protect your own currency. What Russia discovered is that some of its foreign exchange reserves were not accessible all of a sudden when trouble hit. So countries around the world are beginning to wonder, should they find an alternative place to put their reserves? Should they perhaps put more money in China? That is going to happen, but there is going to be a limit to it. Before China's renminbi came on the scene, reserve currencies and safe haven currencies were seen as the same thing. I'm going to argue there is a difference. So there is a medium of payment or international currency, which I think about as a payment and invoicing currency, a reserve currency, which is a currency that you hold your foreign exchange reserves in, and then a safe haven currency, which is a currency that you turn to in times of financial turmoil. The traditional reserve currencies that I mentioned, the dollar, the euro, the pound sterling, the Japanese yen, and a smattering of others, all were seen as having both of these attributes, as a reserve currency and as a safe haven currency. But I've argued in some of my writings that for a safe haven currency, and indeed even for a reserve currency, you need not just macroeconomic size. China certainly is a very large economy. It's about 2/3 the size of the US economy right now. You need deep financial markets. China's financial markets are pretty big right now, even compared to other advanced economies such as Japan. But you also need an institutional framework. What is the need for this institutional framework? Foreign investors and domestic investors need to have trust in your currency. And where does that trust come from? It comes from a framework that includes an independent central bank, the rule of law, and the rule of law defined in the way that even the government has to be subservient to the rule of law. You can take the US government to court here, and sometimes the US government loses. It doesn't happen in China. Third, you need an institutionalized system of checks and balances. Now, one might argue that all of these pillars of the institutional framework in the US have been pretty significantly eroded over the last 5 to 6 years, especially a few years ago. Is this going to hurt the dollar's role? By all rights, it should. The US has a huge external deficit, a huge amount of liabilities to the rest of the world. It's running very large budget deficits. The institutional framework is weaker. Luckily, in international finance, there is one principle that is important above everything else, which is that in international finance, everything is relative. You don't need to have perfect institutions, perfect financial markets. So long as you're better than the rest of the world, you're okay. And that's the position we find ourselves in. It's not that the US is the paragon of all these virtues, but if you think about the combination of economic size, financial market depth and liquidity, and institutional framework, there is really no other competitor. So what we are seeing, and the economist Barry Eichengreen has documented this, which is a very interesting phenomenon in the last few years. The dollar share of global foreign exchange reserves has declined marginally, but the shares of the euro, the Japanese yen, the pound sterling have fallen even more. So whose shares are going up? It turns out it's of the small reserve currencies, the Australian dollar, the Swedish krona, the Canadian dollar, and to some extent the Chinese renminbi. Why? Because countries around the world, reserve managers want to diversify. So what we're seeing is this paradoxical situation where the dollar's dominance as a reserve currency marginally erodes, the shares of the second tier currencies, in which I'm going to put the euro for now, declines even more. So the distance between the top currency and the second tier currencies has widened even more. So what we might end up is in a world where we have much more fragmentation in the second and third tiers, while at the top tier, you see the dollar becoming even more dominant. And again, this might seem like a placid outcome, but I think going back to my theme about developing countries, there are some real risks here. For a country like China or India, I think issuance of a domestic retail CBDC might make sense. It might get traction or not. I don't think it's going to fundamentally alter that currency's role in international finance. But as you think about small countries, small open economies that have less credible central banks, less credible currencies, if a digital version of the dollar, euro, renminbi, or even a stable coin issued by a major corporation such as Amazon were easily available around the world, that could pose an existential threat to the currencies of some of these smaller economies. So I see a lot more stability at the top, a lot of ferment at the second and third tiers, and potentially existential problems at the third tier. So all of this adds up to a world which I think is experiencing an enormous amount of ferment. Certainly, we are moving towards a new international economic order. What form this takes is going to have a very crucial interplay between the geopolitics and the economics, including the currency issues that I mentioned, because they have become much more closely tied together than I might have mentioned. And while one might take some comfort in the notion that while these polarities might actually lead to a little more stability, at least within these siloed groups, even that, I think, poses some very significant risks. Again, it's not good to end on a down note. Certainly, as we think about where digital currencies might lead to us, we are seeing much more improvements in financial markets and systems, much more access to those financial markets. And this is having tremendously beneficial effects in low-income countries, in middle-income countries, where even the low-income segments of the population are getting access to financial markets, which makes them feel more vested in reforms, and I think is good for the world economy at large. But I think there are some real concerns to be had here. So I think I can just sum it up with the title of the last chapter of my recent book, A Glorious Future Beckons, Perhaps. Thank you.
Terrific talk, Professor Prasad. My name is Kevin Gallagher. I'm studies and the inaugural director of the Global Development Policy Center, which is co-sponsoring today's event. We've got a good 40 minutes to have a conversation with Professor Prasad. Why don't I take a couple questions at a time, and we'll let him respond to them, and we'll go around in a few clusters. And so Professor Prasad can start to get to know some of you folks, and we can have a global conversation. Please tell us a little bit about yourself. Tell us your name, what program you're in here, BU, if you're a visitor, so we can get to know each other. I'll take a couple from the crowd, and we also have over 100 people virtually, so I'll take a couple of them after a live round, if you folks don't mind. First.
So, Professor, thank you. Thank you for the great speech. My name is Jing Wei. I'm in MLI program in Boston University. So you mentioned the hard time of many developing nations during the 70s, 80s, and 90s, which reminds me of the very popular theory during that time, the dependency theory. The narrative is like in the global financial order, the developed nations can import goods while exporting poverty to the developed nations. And I also see the diminishing representation of this narrative during this past 10 years. And why do you think this transition happened? And do you think this dependency theory still can be applied to those smaller developing nations? Thank you.
Take a cluster of them, and I'll let you go for it. Other questions? Please.
Hello, Professor. I am Hari. I'm International Affairs Master's student. It was nice hearing to you. And since you were talking about economic sanctions and other alternative currencies, I was wondering, how do you think China's attempt to internationalize yuan and make it a global reserve currency will affect the international monetary and financial system? And do you think will China be able to pass Griffin's dilemma?
How about this side of the table of the room? Anyone over here? Here we go. Wait, please speak into the microphone, please.
I'm Rama Vasudevan. I'm a visitor at the GDPI from Colorado State University. So my question is it's kind of related to the question before, but what is, in terms of the future, you highlight, the talk is very stimulating, but also very sobering. What are the prospects for the developing countries, low-income countries, given that we're not seeing this monetary hierarchy of the dollar changing? You still see a dominance, you still see a kind of asymmetry. So what prospects, would digital currencies and central bank digital currencies provide a way? How does one get greater policy space for developing countries within this framework? And
Let me ask one from the crowd here. It's actually from Suchi Gopal, who's a professor of Earth and Environment, whose building is across the street. And she's asking about this book that everyone tells me I need to read called The Ministry of the Future. She says, carbon is not valued right. Can you talk about digital carbon currency in the global marketplace? She was inspired by the book Ministry for the Future by Kim Stanley Robinson and his mention of Delton Chen. How can such novel ideas save us and help us reduce greenhouse gas emissions? She'll take those cluster and we'll go think about another couple of rounds. We can go about 40 minutes.
Okay,
Please.
That's a good set of interrelated questions. It's going to be a rough world for the developing countries there as we see this process of geoeconomic fragmentation, again, using the IMF's term that I spoke about. The real losers could be the low-income developing countries that have not integrated into the world economy yet, and at the moment are facing a variety of risks. One of the key risks is related to the amount of debt that they have accumulated. I spoke about how there's been a shift away from FDI to other, from external currency, foreign currency denominated external debt towards other forms of inflows. That has not quite happened to the low-income countries yet. So you still see money flowing into these economies, some of it in the form of debt, some of it in the form of FDI, largely targeted towards resource extraction. So that gets to the point about whether this is really going to be beneficial for those countries. And the old Dutch disease problem that you have money flowing into some of these countries specifically for resource extraction that leads to drive up the real exchange rate, which kills off whatever prospects these countries might have of generating homegrown manufacturing. That is still a pressing problem for many of these countries, although at the moment, the more pressing problem is just the enormous debt overhang. So as we think about a solution to this, we need a better international financial architecture. And again, Professor Gallagher has written extensively about these issues. You have two major institutions, the IMF and the World Bank, which are not sufficiently resourced to meet the needs of the developing and emerging market world. The governance structure of these institutions is not in keeping with economic realities because the advanced economies still have essentially significant ownership of these institutions, which reduces their legitimacy in the eyes of emerging market economies. And we don't have the facilities in place to undertake effective debt restructuring, where we bring official private creditors and international institutions all to the table because their interests are not that well aligned. And here too, I think geopolitics is having this uncomfortable role. If you think about China being a very important very important bilateral creditor right now, China's interests are not necessarily aligned with many of the other official and private creditors. So we've come to a standstill in many of these debt negotiations. And it's very difficult to see some of these developing countries coming out from under their debt burdens unless we can find a way of restructuring the debt. Likewise, when we think about the spillovers of US monetary policy, and indeed monetary policy of many other advanced economies to the emerging market economies, we need better liquidity insurance mechanisms so that countries don't feel the need to go out and have to self-insure by accumulating reserves, which is enormously inefficient for the countries involved and indeed for the global financial system. And again, here there are very misaligned interests, and we don't seem to be converging on a way of dealing with these problems in a sensible way. And that, you would think, would be an issue even as we think about climate change, where ostensibly the interests of all countries are clearly aligned. Even there, while there seems to be very broad agreement that something needs to be done, once it comes to strategy, tactics, practical ways of moving forward, there is a lot of dissension on the ground. Professor Mukherjee referred to some of the G20 issues these days, and practically every G20 meeting and the last few summits has tried to deal with the climate change issue, and all we get are a bunch of bromides and platitudes rather than any substantive way of moving together. And of course, COP29 did get us some way forward, but far from it. So I think we need to think about innovative solutions, about how to think about trading carbon credits. Now, having spoken about cryptocurrencies, blockchain is often viewed as the answer to a lot of problems that pervade the world. And I think there are legitimate questions about whether we really need blockchain technology, whether we really need decentralized mechanisms for trading carbon credits and so on. I think you can use perfectly conventional technologies. There are more fundamental problems related to incentive structures, financial market development, and so on that I think are first order problems that might have better solutions. But here again, I think the catalytic power of these innovative solutions is really important. I spoke about cryptocurrencies, generating a move towards financial institutions, central banks getting their act together. Likewise, these sorts of initiatives, I think, might provide a kick in the pants for areas where I think progress really needs to be made. As for the issue about the renminbi, yeah, this was the dream of many emerging market policymakers, that they might have an alternative currency to turn to. China, I think, has adopted the strategy of internationalizing the RMB. I've referred to it in one of my previous books as a Trojan horse strategy. The idea was that, once you say we are one of the greatest countries, economic powers in the world, we should have a currency that matches our stature. That forces you to think about what is necessary to accomplish that. You need a more open capital account so foreign investors can get access to assets denominated in that currency. You need a more market-determined exchange rate. You need better and deeper financial systems. You need a better regulatory framework. And I've argued that Chinese regulators who were pushing this might have seen these benefits as being in China's interest, no matter what happened to the currency eventually. I think, as I just argued, that the Chinese currency will become a more important payment currency. It will become a more important reserve currency because, purely from a diversification perspective, it makes sense for reserve managers to put a little more money in renminbi. But will it become a safe haven currency that fundamentally alters the international monetary system by rivaling the dollar? I think highly unlikely, unless China were willing to embrace a different sort of institutional framework. And if anything, I think we have seen a backsliding in the last couple of years. So I think the ascendance of the renminbi will have its limits, and it will most importantly affect other reserve currencies rather than the dollar, which goes back to my theme of much more ferment in the second and third tiers while the dollar remains dominant.
If we can't get to all your questions, a lot of these are in 3 of his books. One's called Gaining Currency, which talks about the internationalization of the renminbi. The other one, The Dollar Trap, about the future of the dollar. And the new book, The Future of Money, which really deals with all the current cryptocurrency questions. And we've got display copies of each one of those and a QR code if you want to order them. Let's take another round of questions. Start here, my friend. Please introduce yourself.
Hello, my name is Swala Akine. I'm a PhD student at the economics department. I had two very specific questions. The first is about the Zambia debt restructuring, and so the Chinese banks, there's a sticking point where they want the multilateral banks to, also take a haircut on, as well, if they are going to, restructure the debt, and that seems to be where the sticking point is in the negotiations. Do you think that's a thing the IMF and the World Bank are going to be open to, and what that's going to mean for, other countries that are going to, because there's, a lot of countries right now are facing debt crisis. And so is that going to be a thing moving forward in other debt restructuring negotiations? And the second thing is, I'm Nigerian, so I mostly think about sub-Saharan Africa. There's a huge infrastructure gap. Usually the financing hasn't really come from, there's been increase in financing from China, but that's also slowing down recently because they're trying to get out of that space. It's not really paying dividends for them. Where do you think the future of that financing is going to come? Because it hasn't really come from the private sector in other developed countries around the West. So yeah, those are my questions. Thank you.
Thank you. More questions? Up here, wait for the microphone.
I'm Mahesh Kara from the Party School. I had a quick question actually related to the previous one about the infrastructure gap in sub-Saharan Africa and how, like, for expanding financial inclusion, like digital financial inclusion, especially with mobile money in sub-Saharan Africa, where like mobile money penetration is very high, and you don't have necessarily like the brick and mortar financial institutions that you have in other parts of the world. Like, to what extent can a lot of the infrastructure gap be closed by some of the promise of digital mobile money and other types of digital finance options, particularly in low and middle income countries? Yeah.
And I'll bring one in from the hybrid world here. Notes that, interestingly, some of the innovations in cryptocurrencies and central bank currencies, you might think that they might come from key currency places, but one central bank that really has gone out in front of this is El Salvador, which is one of those lower income or lower middle income countries. What kind of lessons can El Salvador learn while it's actually trying to go out and do things that some of the larger key currency central banks haven't done yet? Why don't you take those and we'll do another round or so.
Okay, in answering your question, you took some of the words out of my mouth. I think it's going to be a very challenging environment for low-income countries to generate external financing from the private sector. The debt overhang issue, I suspect Professor Gallagher might have more rich insights on this. It's complicated stalemate. I don't see an easy way out of this because I think China is recognizing the limits of its development financing strategy. And as financial conditions in China tighten, I think China is recognizing that it needs to think more about the economic aspects of its lending. The economic aspects used to be tied in with the geopolitical aspects, with a lot of the lending taking place under the BRICS and the BRIC initiative, BRI initiative, sorry, the Belt and Road Initiative. The concern right now is that China does not necessarily see it in its immediate interest as just signing on to these broader debt restructuring packages, because it ends up losing money, and in addition doesn't, so to speak, get credit because these are seen as programs that are negotiated with the multilateral creditors. So we're going to have to find some strategic ways of involving China and enabling it to see that it is in its interest as well to come up with more sensible debt renegotiation strategies. It's going to be a tough slog. I don't see an easy way of getting the intrinsically misaligned incentives of many of these official and private creditors being easily aligned. Somebody is going to lose money, and who loses money and in what proportion, of course, is the key issue. And what sort of benefits you get from any losses you entail is an important issue as well. So on the financing, connecting with the earlier issue, I think there is a broader set of imperatives here, how you can bring more people in low-income countries into the economic fold. And that has a broad set of implications. If you think about very fragmented societies, fragmented economic systems play a role in that. If you don't, as I mentioned earlier, have easy access to not just a digital payment system, but a way of managing your savings, your credit, and so on, that leads to very inefficient outcomes. And it makes it much harder to harness even the domestic savings of countries in a way that can be used effectively. Now, in some of these emerging market economies and low-income countries, you have fintech platforms that are trying to directly connect borrowers and savers, but those are not working very well because it is operating in an environment where the institutional framework is not that good. So I think digital technologies can play a very important role, and it plays a role not just in bringing people into the financial system, but that also gives them a sense that they are vested in whatever reforms are undertaken in the country. And this is true for developing countries, both low income and middle income. When you think about undertaking reforms, there are costs and disruptions always. But if people feel that it's just the political and economic elites who are benefiting from the reforms, those are dead in the water. It's really only when you have the ability to undertake reforms where everybody feels that they have a vested interest that I think they have any chance of success. And I think digital technologies are showing us the way. They're not the complete answer. They don't substitute for institutional frameworks and so on, but they're a very important first step, which comes to the question about El Salvador. So El Salvador, as some of you might have heard, has adopted Bitcoin as the legal tender. So how's that going? At some level, very well, because a huge number of digital wallets, which are where you maintain the cryptocurrency, are being held. But as some researchers have shown, the amount of transaction volume is very limited for one of the reasons I mentioned earlier, that Bitcoin is very volatile. Now, El Salvador is a country where the domestic currency was so volatile that, in fact, people stopped using it and started using US dollars. So relative to the El Salvador currency, whatever there is left of it, yes, Bitcoin actually looks kind of stable. But at some level, it was a Hail Mary pass by a government that, had significant constraints on its domestic finances, had a population that was screaming for more services, and where the new president rankled under the what he considered the dollar hegemony. So Bitcoin comes along, and this was a time 2 years ago, when it looked like Bitcoin's price could go only one way up. So it was a perfect combination of solutions to a series of intractable problems. First of all, you get away from dollar hegemony. Second, if the government acquires a lot of Bitcoin and the value of the Bitcoin goes up, you can buy more stuff from the rest of the world. So government finances become less constrained. If people in El Salvador have more Bitcoin, their wealth goes up. The government has to provide less services. Win-win situation in every respect. Unfortunately, this was a Hail Mary pass by a government that was trying to make up for its failed policies. And as you might expect, that experiment didn't go well because, as we all know, Bitcoin's price fell very significantly, although where it is today, I don't know, it may have gone up, it may have gone down. But it exposed the people of El Salvador to a huge amount of volatility. So ultimately, even if you think about digital currencies, one principle still holds true. Whether you issue your currency in physical form or digital form, how good and credible a central bank you are is what matters. Even if your currency is digital, if you're a central bank that nobody trusts, and it could be because the government is basically using you as a printing press to finance its deficits, in that case, no matter what form you provide your money in, people aren't going to trust your money, which means that it is going to lose value. It is going to lead to higher hyperinflation. So I fear that while there might be a role for central bank digital currencies in the menu of payment options, viewing digitization as the solution to institutional or macro problems is probably a bridge too far.
Salvador is not the model. Huh? More questions in front.
Hello, I'm Cecilia Springer from the Global China Initiative at the Boston University Global Development Policy Center. So I wanted to come back to the concept of geoeconomic fragmentation that you mentioned. And you said that this term is, the IMF is writing a report on this. So I was wondering if you could share a little bit about the potential IMF stance on this topic and, what role they might play in addressing this fragmentation. And then second, you also mentioned that concentrating production can lead to more susceptibility to climate risk, for example, as well as geopolitical risk. So when it comes to climate change, we know that there is a set of technologies and associated raw material supply chains that are going to be necessary to scale up in order to meet climate targets. So if this concentration occurs, what other risks do you see in the ability to combat climate change, and what other economic theories or empirical evidence might you put forward to argue against the friendshoring that is starting to occur in this scale up of renewable energy technologies and the raw materials needed to build them?
Thank you. I'll have the person right behind you, and then Kai.
Hi, I'm an undergrad student, study IR and economics. So in both the departments, I guess.
And you are?
Wen Tao. Yes. So I'm just wondering, can Fed do more? Can the Federal Reserve do more in these cases, especially in times of liquidity strain around the world? For example, like I remember back in the COVID crisis, Fed opened like special swap line with like a special facility for COVID emergency, like liquidity lines. So would the Fed be able to do more in terms of in a global scale? But would it be a political sounded option? Because it might have some, feel like it might get some, domestic backlash in terms,
Hi, I'm Kei Tang, and I'm a research fellow at the Global China Research Initiative at the GDP Center. So I have two questions. The first is, given the debt crisis now in the global south, one of the requests from the Chinese side apparently is that the multilateral also gets joining the haircut. But the multilateral, of course, says we don't want to lose our AAA credit rating. So, in thinking about this, just, puzzle, do you think there would be ever an opportunity for the multilateral to really agree on what China does? Or if they don't, what then the solution would be? The second question would be more about career advice, since, it's like, a situation to consider this. And I think many people will also be interested. You worked in both multilateral and academia. What do you think, as social scientists, would be the best way to contribute to the work, and what are the different perspective of contribution from either the academia side and the international organization side?
Thanks for asking that last one. I usually ask that on behalf of students because they're too shy to ask you that one. Let me just pull one in from, I know these are all, these folks have asked you to explain and save the world all in a couple of minutes, but we have to throw one in here from Karina Jedrzejowska. Hopefully I'm not pronouncing your name wrong, because she is writing in as an assistant professor from the Faculty of Political Science and International Studies at the University of Warsaw. And she says, during the lecture, several threats generated by cryptocurrencies, CBDCs in particular, were mentioned. Her question addresses the potential positive outcomes. Do you think that wealth generated through cryptocurrency trading can contribute towards closing the development funding gap and help achieve goals of the Agenda 2030? In particular, do you think cryptocurrency and the concept of sustainable financing in terms of sustainable environmental development can be compatible at all? Thank you for more. Thank you from Warsaw.
Okay, so geoeconomic fragmentation, again, the IMF term is a good place to start. That study will come out in 2 or 3 weeks, and I helped them with some aspects of it, but I'm not revealing any Paris secrets here. Basically, what they find is that, and it's quite an intriguing finding, that if you look at countries that are more geopolitically aligned, FDI flows are beginning to become much more concentrated. You don't see these quite in the stocks yet, but in the more recent flows in the last few years, they find that there are implications. And it turns out that there are, as you might expect, implications in terms of technology transfers, in terms of other types of expertise. And this concentration also means that you end up with some of the lower income economies essentially getting left out. So you have countries that, are not only politically aligned, but are economically a little more similar as well. So this substantially reduces overall economic efficiency. And in fact, some of my Cornell colleagues have done this work looking at how the restructuring of supply chains might affect both volatility and average levels of output or welfare. And it's pretty clear that you get lower volatility, but you do experience a significant trade-off in terms of welfare costs for giving up that volatility. So it's not necessarily a win-win. And then the climate issue pervades many of these. And I fear that as countries, try to become more secure in terms of their input sources and so on, that means less diversification. So of course, you may have some domestic diversification as countries look to alternative sources of energy. But it means that in the transitional period, they're going to be less eager to shift away from traditional sources. And in fact, we might well end up with the US viewing energy self-sufficiency as leading to the next stage, which is the US becoming an even more significant exporter of energy to countries that are geopolitically aligned with it, such as Europe. So they're less dependent on Russia and so on. So it's not obvious that this is going to be a huge plus for the climate agenda. Now, one could argue that if you have more closely and regionally centered supply chains, you have less transportation involved, you might in fact get a reduction in the climate change effects of transportation. That's possible. I don't know how large those effects are going to be and whether they offset some of the forces I spoke about. In terms of the international finance angles, I think there are some significant issues here about the dollar dominance having an effect on the rest of the world. And here too, there is a geopolitical overlay to this because the US does provide swap lines because at a time of crisis, what does the world want? It wants dollar funding. The US has standing swap lines with 5 major central banks, advanced economy central banks, and a handful of others that are activated, that were activated during the global financial crisis, that were reactivated during the COVID pandemic and so on. But the reality is that these are all at the political whim of the US. So countries don't feel they can rely on it. So emerging market countries like India, Indonesia, and so on now feel that they have no choice but to accumulate reserves on their own. So could the Fed do more? It could certainly provide dollar funding at a much larger scale, but it comes with big risks because if you think about swap lines where countries swap their currencies for each other, the question is who bears the exchange rate risk or potentially even a default risk. And so far, the notion that the US might bear the risk of lending to an emerging market currency, even though it is just a swap in terms of currencies, it's not obvious. The People's Bank of China has set up its own swap lines with a large number of countries around the world. Some of those have been used. Argentina, Hong Kong have used those swap lines, but the problem is that the world doesn't really want renminbi at a time of financial crisis. It needs dollars. And likewise, as we think about whether cryptocurrencies will be the answer to the world's problems, again, is you think about where the underlying value of decentralized cryptocurrencies is coming from. It's not obvious, when I go to the crypto conferences that I spoke to earlier, I'm the party pooper because I start asking uncomfortable questions like, what is the intrinsic value of Bitcoin? What is the valuation model underlying Bitcoin? And there aren't good answers to these questions. So if one is relying on a purely speculative financial asset where the basic valuation models just seems to be scarcity, I worry about relying on this as a medium of exchange, as a way of generating finance and so on. But having said that, again, cryptocurrencies do show us ways of moving money. I mean, we've heard about, money flowing to Ukraine through cryptocurrency channels, but it can also be used to take money out of countries. When China imposed capital controls in 2014, 2015, the demand for Bitcoin from Chinese IP addresses spiked. There is a notion that Bitcoin is being used to take money out of Russia, out of Iran, and so on. So it's a mixed blessing. It can bring in some money under dire circumstances, but it could also lead to money flowing out. Finally, on the advice, again, there are people in this room who have much more distinguished and long careers than I have. My own perspective on this is that it's important to be grounded in the big questions. You know, when, those of us who are here as academics in this room, we get to do research which is an intellectually enriching, exciting, but also a slightly grinding process, seeing a paper through to publication. So you have to be really vested in this process of, trying to answer some difficult questions. So if you look at some of the research that Professor Mukherjee has done, those are very important questions about institutional development that he's tackled. And these are very tough questions. So it's important to have these big picture questions in mind, but sometimes you do have to narrow down those questions so you can ask them in a more precise and specific way that you can answer them somewhat more specifically. But some of our academic colleagues, do tend to lose sight of the forest because we tend to be hyper specialized in our own fields. But I know that many of the faculty at BU, and again, one can invoke Professor Paul Streeten and his very distinguished record. You can see how you can manage this tension between doing really important, interesting analytical work that has implications for the world around us, while still being able to meet standards of academic rigor. It's not an easy challenge, but it's a challenge that I think we all relish.
Maybe another round or two of questions. This side has not been asking as much questions. Here we go over here.
My name is George Ogay. I'm an alumnus of the BU Economics Department. FTX is kind of a cautionary tale, and there have been other crypto-related bankruptcies. And my question is, given the example that we've seen of international cooperation with standards like Basel III, do you think that there's prospect for and the need for international regulation of crypto, or at this stage of the industry, we're really talking just national?
Woman in front of you.
I'm Neva Goodwin. I'm also a graduate of the Economics Department, and Paul Streeten was my dissertation director. Very fortunate. I'm thinking about financialization as something that has been increasing in the decades. That is the extent to which capital is more and more in financial instruments and less involved with the real economy. And something, just as an example of concern in this, is the growing interest in investing in resources such as water. Agriculture is another. And I'm concerned that the desire of investors, so we're now talking about the private sector rather than government, the desire of investors to maximize return. And increasingly, as they use private equity, they're using instruments that are not regulated, not very transparent, and whose social and environmental impacts are not clear. I'm concerned that this is leading in a pretty bad direction, and again, particularly towards the ownership of really important basic resources such as water. So just interested in your perspective.
Great. Okay, this side of the room is doing pretty well, but only the front. Oh, so we're getting moving towards the back.
I have a question on privacy.
Please introduce yourself.
I'm Bob Dench. I'm a graduate of Westrum and a former senior fellow at the law school. But privacy, I know in St. Louis you spent some time. Privacy dimension. I know in Washington right now there's a discussion interagency about the international versus domestic privacy dimensions of the digital currency. You could discuss that. Thank you.
Okay, one from this side, and then we'll go to hybrid and we'll let him respond. Thank you, Ray.
Thanks so much. I'm Becky Ray with the GDP Center, and I'd like to ask a question about the geoeconomic fragmentation that you mentioned. I specifically study Latin America, which finds itself increasingly being asked to do business with one or the other side of the Pacific and doesn't really seem to want to take sides. So I'd like to ask you to talk a little bit about, from a global South perspective, how does geofragmentation impact developing countries' options to foster competition among potential varieties of investors and trading markets? Thanks.
Does it give them more agency, or is it going to lock them into some of the dependency questions that were asked before? Let me just take one here from Abdul Sufi. Doesn't say where Abdul is from, but Abdul was really struck about one of your comments about the future of the U.S. dollar and the sort of unprecedented acts that the central bank took with Russians reserve holdings. What do you think? How do you think the Chinese are looking at this, and to what extent do you think that is accentuating this potential interest in moving away from the dollar? Even though, like you, I don't think it's going to go away anytime soon, but it's talked about at water coolers and bars more than ever, right?
Yeah, it seems like something that by all logic should have happened or should be happening, but it's in. But let's start with the world of cryptos. This is there are many ironies and paradoxes once we start talking about cryptos. So the notion of Bitcoin is that it's supposed to be a decentralized payment mechanism, meaning that it is sort of people power at its best. There is no centralized agency or institution managing the payment network. But the odd thing is that once one starts looking at the cryptocurrency world, the parts of it that work are really very centralized. Stable coins work as payment mechanisms, sort of, and stable coins are issued by a particular agency that does the validation, that determines the rules of the game. So it is completely centralized. If you think about why FTX ran into trouble, exchanges like FTX, Coinbase, and so on are seen by people as places where they can keep their cryptocurrency holdings and trade them in a secure way. So that again is centralized. So the notion of decentralization was we get away from these central points of failure, these big, bad, ugly banks that could fail and bring the system down with them, because now everything is distributed. But what we're finding out is that a lot of what happens in the crypto world is in fact highly centralized. Even if you think about Bitcoin, the process of validating transactions is done through something called mining, which basically requires expending a lot of computing power to solve certain numerical problems. And that gives you the privilege of validating transactions, and you get rewarded with Bitcoin. It turns out that there are a few mining pools that basically control much of the validation that occurs in the Bitcoin blockchain, which in turn means that they could in principle change the rules of the game as well. So every aspect is now becoming much more centralized, thereby leading to more vulnerability. And there are concerns, not only that there are investor protection issues here. So, people putting their life savings in Bitcoin because they thought that this is a wonderful technology and the price can only go up. In addition, there are issues related to spillovers into traditional financial markets. Stable coins that I referred to earlier hold treasury securities. If you have a wave of redemptions on treasury securities, you could get huge amounts of selling pressure in the treasury securities market that disrupts what is the bedrock of the US financial system. So there are very important imperatives to move forward in regulation. The problem right now is that countries are doing this on their own. The Europeans and Japanese have gone ahead with things. The US is proceeding on a piecemeal way because we have all sorts of regulatory jurisdiction issues with different agencies trying to manage this. So it's turning into a mishmash, unfortunately. I think a globally coordinated approach would work more effectively. But right now, practically every country seems to be, except El Salvador, seems to be trying to squelch cryptocurrencies and bring them to toe. The financialization is a pretty important issue. Again, with cryptocurrencies, you can think about some good things potentially happening. So there are many low-income communities, farming communities, and so on that don't have access to international finance, let alone domestic finance. Now, suddenly they have access to a pool of global finance that you can get by securitizing things on the blockchain. So again, you don't need governments or banks playing a role here. But the risk that you mentioned is a very important one, that people essentially see a little pot of money before them. They don't quite know what they're giving up in terms of land use rights, water rights, and so on. So without a good governance framework, all of these benefits, I think, may be substantially superseded by the many, many risks that are emerging in this space, in addition to the risks that I spoke about that are being created by cryptocurrencies more broadly. And as we think about cryptocurrencies, the privacy issue is an important one. Here again, Bitcoin was supposed to move us to a world where we could conduct transactions without having to rely on a commercial bank or a credit card company or some sort of third-party financial services provider. But again, in this grand irony, it is leading us to the world where all payments may be digital and where ultimately every payment may be visible, every transaction may be visible, either to a private payments provider or to a government agency or central bank. And I think it's very important, and we were discussing this earlier, whether we should have a discussion about this, not just as economists or technocrats, but really at the level of society. And at the St. Louis keynote lecture that I was that you had referred to, I talked about some of the darker possibilities. You can think about digital money is wonderful because you can easily transact it, but it is also programmable, which again might be wonderful at certain times when you want to send out money to people in a lump sum fashion at a time of crisis. The economists fantasize about these as helicopter drops of money. The COVID payments were precisely that. And, being able to just deposit money in their digital wallets, CBDC digital wallets, without having to deal with, checks or debit cards and so on is very attractive. But you could also program some features into the money that it expires after a certain date. You could program certain features into it, like food stamps, that money can be used for certain purposes, but maybe not for buying drugs or ammunition or pornography. So suddenly you could see money becoming an instrument, not just of economic policy, but of social policy. Now, this might seem like a very dark and dangerous world, but I might remind you that technology that was supposed to bring us all together, enable us to connect with each other, has led us down some very dark avenues. So I think it's worth worrying a great deal about. But the reality, and again, I had a discussion with some students earlier, most of the people in the room seem to view the privacy issue as something that, has flown out the barn already. I'm not flown out of the barn, it's not good, that's mixing metaphor, has left the barn. But at least for some of us of our generation, I think these are very significant concerns that we need to worry a great deal about. In terms of whether this is going to, again, fundamentally alter the international monetary system in any way, I don't really think it's going to have a huge impact. Certainly, the world has seen that sanctions can be very powerful, that even reserves are not invulnerable to being locked up by sanctions. But once you start thinking about where a country might put its foreign exchange reserves, there aren't many alternatives out there. You've no doubt heard about central banks buying a lot of gold. Sounds like a lot, thousands of tons of gold, but 1,000 tons of gold at current market prices is about $80 billion. Sounds like a lot of money. The total amount of foreign exchange reserves held by central banks around the world is about $11.6 trillion. So it's just a small sliver. Again, if you think about diversifying into other currencies, many other currencies like the Swiss franc, the Japanese yen, don't want money coming into those countries because their currencies would appreciate. So if you think about a market that is very deep, very liquid, that can absorb a few hundreds of billions of dollars worth, and where you can easily liquidate those, there really isn't much alternative to the US dollar. So I think we are pretty much stuck with the US dollar as the dominant reserve currency. Again, not because it is the paragon of all things great and good, but because there isn't much of an alternative.
Terrific. One last round, and I have one question. I used to have two, but you asked the career advice one. Please.
Great. Thank you. My name is Rishi Bhandari, and I work at the GDP Center. In the spirit of asking very big picture questions, I was wondering if you could reflect on the role of the IMF and how you see that evolving. I was particularly struck by your comments on the legitimacy of institutions. And so I was wondering if you could reflect on how you see the fund's role evolve, especially in light of climate change. I'd appreciate that. Thank you.
Okay, I'll ask the last question. In the sort of in the Streeten tradition, what are some of the insights in the academy that really helped you when you were a policymaker? And now that you're back in the academy, what are some of the insights that you learned as a policymaker that helps you be a better academic?
Those are indeed big, broad questions, and good ones to end the evening on. IMF legitimacy and legitimacy of the international financial institutions is really a critical issue. I mean, if you think about the voting structure at the IMF, China right now has about less than a 7% quota, while its share of global GDP is even at market exchange rates about 15 to 17%. So China's GDP at market exchange rates is more than that of Germany, the UK, France, Japan combined. And if you put all those countries together, they have a combined voting share of something like 19 to 20%. So this doesn't make any sense. And of course, one response has been for the emerging markets to start setting up their own institutions. So they get to define the rules of the game by setting up their own institutions. What is interesting is that when China and the other BRICS economies set up the BRICS Bank, or China set up the Asian Infrastructure Investment Bank in tandem with a large number of other countries, China did want to make the point that it was not going to subvert the existing rules of the game, but hold themselves to that, not just in letter, but in principle. In other words, making sure that no country would have veto power over major policy decisions, even though most people believe that, China does have effective veto power at the AIIB and the BRICS Bank. But at least they're trying to send the message they want to be better than the existing institutions. But I think there is a significant set of issues for the IMF in particular, whether it has enough resources. If you put all its resources together, it amounts to about $1 trillion, which in a world where, FX reserves alone are about $11.6 trillion, that's not that much money. So in terms of resources, in terms of the governance structure and how those two are linked, there is a lot to be done to ensure the legitimacy and effectiveness of those institutions. Am I very optimistic that we will see big change there? Given that it's intrinsically a zero-sum game, I think that change will be a long time coming. And as for the insights, Kevin, I've been at institutions throughout my life, whether it was the IMF, Cornell or Brookings Institution, where analytical work really is the coin of the realm. But having said that, I think it's also useful to understand the relationship between different aspects of policies and also the constraints that policymakers work under. In my younger days at the IMF, it used to be easy. I started working on China just when China was opening up in the early 2000s, laying out the first best, what China should do in terms of its financial market reforms, how soon it should get there. I had all the answers. And then I realized that those answers had certain problems. That when you think about an economy where there are lots of weaknesses in terms of the institutional framework, in terms of the imbalance among different sectors of the economy, if you say, let's open up the capital account or liberalize financial markets, when you don't have good corporate governance standards, when you don't have good auditing and accounting standards in place, when you don't have good corporate transparency, you end up with a lot more volatility. Likewise, Professor Raghuram Rajan and I had a very persuasive essay that we taught in the American Economic Review, where we argued that China can take its incremental reform strategy so far, But when you start thinking about capital account liberalization, exchange rate liberalization, if you're trying to do it step by step, it's actually going to backfire on you. By God, the Chinese figured out a way to do it. They did move forward with incremental capital account opening, incremental exchange rate reforms. It did have some negative consequences for them in 2014, 2015, when a lot of capital fled the country because the government did not communicate its policy intentions well enough. But recognizing these constraints in terms of policies, but also being intellectually honest, number one, in terms of, what our models can tell us in terms of the insights, but also the limitations of the models when you apply them to the real world. Those, I think, are important lessons for us to bear as academics, but also as policymakers, because at one level, it's very easy to start thinking about plausible sounding solutions. But many of these can have unintended consequences. So thinking about these in a general equilibrium sense is really important. So I think that academic rigor feeds into policy making, but at the same time, for academics to fully understand the practical realities of policy making in a very imperfect world, I think is the key issue. And as you say, this is very much in the Paul Streeten tradition of merging academic and policy work.
Terrific. Well, thanks so much. We've been everywhere in the past couple hours. Globalization, development, cryptocurrencies, and the poorest countries in the world, and climate change. We could go on for another couple hours, but we've got a great reception waiting for us in the next room. I just want to put in a little bit of a plug for the three co-sponsors of this, especially take a look at the Institute for Economic Development at the Economics Department, their new webpage and their new annual report that gives a good idea of all the things that they've been up to over the past couple of years and their seminar series and so forth, and the GDP Center webpage. And as I mentioned earlier, we have Eswar Prasad's new book. Actually, I've got to run it back out there. But we have his new book, The Future of Money, in addition to his other two books out there with a QR code that you can order from. So please keep your eye out on the Institute for Economic Development webpage, the GDP Center webpage. You can follow the GDP Center on Twitter. Can you follow you guys on Twitter? No? Yeah? Not yet? The Economics Department, you can, though. I know that. You can follow the Economics Department on Twitter to find out about more of the kinds of conversations like this that we have. But before I invite you all to a reception to carry out all of these conversations on our own, please help me in welcoming and thanking Eswar Prasad for giving this distinguished lecture today.